Is whole life insurance a smart investment? This is a question I get asked a lot from my financial coaching clients, so I figured it was time to do a whole video on it. I'm Penelope Jane Smith, and I run a 7-figure financial coaching and training company called Real Prosperity Inc., where we specialize in supporting women entrepreneurs to become financially free in 5 years or less. So in this video, I'll explain how whole life insurance works as an investment and break down the pros, the cons, and things to consider to see if a whole life insurance policy could be a good investment for you. So tap the like button and let's dive in. There are two main types of life insurance policies that we're going to talk about in this video. The first is term insurance. This is the least expensive type. Term insurance is for a specific term or specific period of time. As long as you pay the premiums, if you die within that time frame, the insurance company pays out. If you die after that time, the insurance company doesn't have to pay. So you might have a 10-year term, a 20-year term, a 30-year term, whatever the time frame, you just make your payment during that term. If something happens to you in that time frame, the insurance company pays out. Otherwise, you're done. You don't owe them anything else. You don't get anything else. This type of policy doesn't have any extra savings plan or weird gimmicks built into it. It's just straight up insurance. I got a 20-year term policy when I had my first baby because I figured that after 20 years, Gabriel would be an adult and not dependent on my income at that point, and my husband, Paul, wouldn't need my income to support his lifestyle. The other main type of life insurance we're going to talk about is some kind of whole life insurance. You might hear a lot of different terms: whole life, cash value, universal life, variable life, etc., etc. There are some differences, but they're all basically the same in that you pay more than you would for term insurance, but it doesn't expire after a specific term. So you can keep it for your whole life, right? That's why it's called whole life insurance, as long as you're paid up and don't cancel it. And how this is often explained is that in addition to paying your heirs if something happens to you, while you're alive, you build up this little savings account, which can grow tax-free, and you can even borrow against it. So some people say that term insurance is like renting and whole life insurance is like owning. So with term insurance, you're just throwing your money away because at the end of the term, you don't get anything. But with whole life, you keep it and you can borrow money from yourself. They say it's like you're being your own bank. There's even a whole book on this concept called Infinite Banking. Sounds great so far, right? Be my own bank. Love it. But here's the part I'm nervous about putting up on YouTube, because I know people, some of them are friends, mastermind buddies, and referral partners that are all in on infinite banking and even sell these policies. And I don't want to alienate them. So let's do this. I'll share what I've come up with in my own research. And if you disagree, I invite you to prove me wrong, but don't just tell me I'm wrong. That's not helpful. Show me the actual numbers. I want to see them because I would actually love to be wrong about this. I so want to be wrong. I love the idea of being your own bank. I would love for this to be the secret billionaire hack that I get to teach you. But after years of studying this, reading books, taking courses, consulting with different insurance agents and financial experts, and going line by line through more insurance illustrations than any reasonable human should ever have to, I just don't see it penciling out. Here's how I see this actually working in real life. First of all, the premiums are 10 to 20 times as much as term insurance. So for me, instead of paying $100 a month, it would be more like $2,000 a month. And typically, for the first 5 years, guess how much of that $2,000 goes into my savings account part? Sometimes you can see something in the first year, but a lot of times it's zero. Zero. So in 5 years, I would have invested an extra $114,000. And what do I have to show for it? Nothing. Nothing. Most of it goes to commissions. So I can see why insurance agents like to sell this, right? So I'm paying 20 times as much and getting nothing in return for years and years and years. If I cancel the policy, I just lose all that money. But this is a long-term investment, they'll tell you. So let's say I keep the policy. Eventually, that little savings account starts building up, except it's not actually a savings account.
What?
This is one of the things that drives me crazy. It's just the amount of my death benefit that I'm allowed to borrow against while I'm still alive. So imagine, I go to my friend Shannon and I ask her to hold on to $10,000 for me. And she says, sure. Then when I want to get my $10,000 back, she says, you can't have it back, it's mine now. But I'll tell you what, I'll lend it to you at 5% interest. So now I'm paying her interest to borrow what was my money. How is that a good deal? And if I die, do my heirs get to keep that extra money that I've been paying? Typically, no. Most of the time, the insurance company just keeps it all. Like I said, I wish this wasn't the case. If I'm missing something, please show me. But when I run the numbers, every time I just don't see how it makes sense. And I'll break it down for you in just a moment. Now, if you already have a whole life policy, don't just get rid of it. If you already have it, it might be worth keeping. So get some coaching to help you evaluate if it's better to keep it or let it go. In the meantime, I want to give you a breakdown of how this works so you can see the actual numbers. In one of the courses that I did, the facilitator said that they would teach us how to use this to have $30,000 a month in passive income from the time you're 65 until the time you're 100. $30,000 a month in passive income sounds great, right? Sign me up. So would you like to know how to have $30,000 a month in passive income from the time you're 65 using a whole life insurance policy? Would you like to know how to do that? Okay, here's what you need to do. All you need to do is put $100,000 a year for 40 years, starting at age 25, and then once you're 65, you can borrow $30,000 a month against your policy. And when you die, instead of giving all that extra money to your heirs, the insurance company keeps it. I have so many problems with this, starting with how many 20-year-olds are able to put aside $100,000 a year after taxes and living expenses? But let's just say that you're a super high income earner and you could invest $100,000 a year. What would happen if you just got a term policy and invested the difference in an index fund? I invested hours of my life that I will never get back in creating a whole spreadsheet with a term life insurance quote from Zander Insurance and assuming an 8% average return on investment and having to pay 20% in capital gains taxes on average. So bottom line, you would have over $8 million at 65, which your heirs would get to keep if something happened to you. And if you started pulling off passive income at that point, you would have a little over $44,000 a month in passive income. If you had to pay 20% in taxes on that, you would still have over $35,000 a month after taxes, which is still more than the insurance example. And the truth is, you wouldn't have to pay taxes on everything. You could have at least some of that money growing tax-free in something like a tax-sheltered retirement account, like a 401k or IRA. There are a lot of people out there calling themselves financial advisors or wealth advisors, pushing these policies on high income earners who know how to make money, but they don't know how to manage or invest it wisely. The so-called wealth advisor tells them they need to put $4,000 a month into a whole life insurance policy. And they just conveniently neglect to tell you that it's 20 times as expensive as a term policy, and the insurance company will probably just keep that extra money. And I guess that's better than not investing in anything at all. But the biggest problem is the opportunity cost of what you could have if you had just invested the money in something else. You know, I believe in having life insurance if you need it, but what makes the most financial sense is to just get it for the term you need. Keep it simple. Don't try to combine life insurance with investments for retirement. Don't try to combine life insurance with savings accounts. Don't try to combine life insurance with saving for a kid's college. Anytime you hear somebody combining life insurance with something else, assume it's code for you're about to get ripped off. We'll do a deep dive on investment strategies at my Financial Freedom 101 online 3-day event. So if you want to understand investing better and be a good steward of your money, I highly recommend you join us. If you're not already registered, go to financialfreedom101online.com to check it out. In just 3 days, you will get the money tools, skills, and systems you need to be financially secure for the rest of your life. Thank you for watching, and I'll see you there.